Everybody. Uh, this is our fourth lecture on finance group FMG 402 finance, banking and finance. As per our lecture schedule, we already finished introduction, Indian banking, financial system, banking system in India, commercial bank and product of the services. Today we unit credit appraisal. So today we start credit appraisal. This is our fifth unit. In this unit, we know all credit appraisal meaning and the process of credit appraisal and credit rating. So this is the main criteria which bank give the loan or the financial activity credibility of any firm. Uh, the biggest risk of face of the commercial bank is the credit risk, which is associated with the uncertainty of borrowing, default to payment of the loan amount. It is the obligation of the bankers to adopt the effective credit approval. This appraisal mechanism gathering loan, which is involve evaluation of the borrowing and credit of the future ability, will interest and physical repayment. The banker should be proactive in the administrating the credit approval and appraisal system. For the loan risk, for the loan review, the mechanism can be used effective tool aim to cover the entire portfolio credit and the credit cycle starts from the domestic post all problem recovery. Bank should have through the knowledge of the prudential norms and the Basel according to the guidelines of the credit risk to managing the administrative review mechanism review mechanism in this process of loan review, the mechanism identify and ascertain the credit quality of the timely credit component in an appraisal system. Hence, the loan risk review, the mechanism can be termed as key factor in determining the soundness and financial health of the banker. This chapter aims to understand the chapter of the credit risk need of rating mechanism of the commercial bank and suggest uh, mitigation which loss caused due to the loan asset. Getting the term loan from the bank, getting the term loan from the bank, the financial institution not easy. So corporate asking for the loan. Hence, to give through the several stages of the assignment before the actually getting a loan. Bank follow the exhaustive process of the credit approval before sign, especially in terms of its technical ability, economic visibility of the bank ability, including the credit worthless of the productive borrowing. The credit appraisal process of a customer include assigning whether the customer is liable to repay the loan amount in the situational time and or not. Hence, here the bank have their own methodology to determine the whether borrow the creditability is not or this determined to terms of the norm and standard set of the bank. All bank employ their own unique objective, subjective, and financial and non-financial techniques to evaluate the worthiness of their customers. The primary object of credit appraisal is to ensure the money is given to the right hand and their capital and interest income of the bank are relatively secure. The credit appraisal process in appraisal of the market management and financial feasibility of the object of the project. This that is to be financed in credit appraisal in normally done by the bank to ensure the following. As per this paragraph, the main object is clear. The primary object of credit appraisal to ensure that the money is given to right hand. So please underline this word. After that, they given various terms and points to elaborate credit appraisal, safety, liquidity, profitability, risk diversion. So these are the main points which are basically we see in when we give the credit appraisal to any firm. So first point is safety. Safety. The first rule of the leading is ascertain the safety of the advance made. The means of assignment of the repaying the capacity of borrowing and the purpose of borrowing. It is also include the assignment contingencies and the fallback plan for the same. This ensure to talk adequate securities by way of graduate collateral changes of property, etc. to safety is major. Liquidity. The second rule of the leading is to ascertain how when the repayment of a advance made would happen and their repayment is timely this is done by ascertaining the availability of the funds in the future of the ensuring there are the funds are not locked up in a long period. So liquidity is must because if the firm is not giving business as per the schedule, so liquidity is not sufficient. So this firm is risky in the point of credit rateability. After that, next point is profitability. The third rule of the lead the higher rate of interest than the borrowing rate. This is called interest margin. Right? So we focus on profitability, which is our third point. The third rule of leading is to leading the higher rate of interest than the borrowing rate. This is called interest margin. One hand to take a balance between the profitability and the safety of the hands. The interest rate must be charged in comparatively, but the same time the spread should be adequate. Means if the profitability is good enough and in the basic ratio at that time, we give credit appraisal to this company. Next, last point is risk diversion. The old says that never put all your eggs in one basket. A lead must diversify the customer base. Uh, Diversion must be made in the terms of geographically location, borrowings, industry sector, etc. Um, in short, as the point of view balance, we should not make any one criteria for selective companies. We versatile adjust all industries, and we give credit appraisal to various varieties of companies. Means you give cotton industry or mechanical industries or any other industries. So the technically all industries are different and the profitability is different. So the risk diversion is be different also. We can spread our credit rates to those companies which are more uh, reliable with us. Next term is process of credit appraisal. The loan by commercial bank. Credit appraisal is process of ascertaining the risk association with the extension of the credit facility. It is generally carried out a financial institution. They are involved in providing the financial funding in their customers. In his process, the proper evaluation of the borrowing is performed, which measure the financial condition and the ability of the customer to repay the loan in the future. The bank starts the credit appraisal once the application is received from the loan of the borrowing. Generally, the appraisal process includes the following steps. First step is a receipt of the application. Means first this customer gives one application, and this application contain all financial ups and downs of this company and to maintain the same. Next step is pre-sanction. A visit by bank officer means any one specific bank officer will visit the firm and maintain how to manage these all terms and conditions in this firm. He verify all criteria in one by one and make one report. After that, this they given various points which related with this verification. Next, RBI defaulting list. RBI every year RBI display one which they are not as per the terms and condition, and they are not repay the loan and all financial conditions as per norms. So they we first check these defaults. Title clearance report of the proprietor to be objection from the appraisal value. Preparation of the financial data. After that, we give the financial data and we can prepare this. After preparation of the loan proposal will be fill up by this. After that, all terms and condition when the firm is okay and the as point of time it is good to enough for credit appraisal, then the approval proposal sanctioning the loan will be given from bank to the company. After that, this related firm will manage all money of loan and they can submit all the terms and condition which bank given, and the bank allow to transfer money the firm's account, and after that this period of time firm repay the loan as well as interest. So this called disbursement of loan. After that, some some part of business activity, bank sanction additional loan also when the appraisal is good enough or the customer is very keen to repay the loan and the such activity. At that time, all banks are provide more money to loan, and the customer also happy, he will be happy customer for the bank. Next term is credit rating. So these are the terms and condition and the process to related with how to give credit to any firm from bank. Next term is credit rating. Credit rating is allowed credit rating allowed once to evaluate the credit worthiness of the business. Yes, the credit rating allowance to evaluate the credit worthiness of the business. The evaluation of the made by the credit rating agency, the credit rating debtor's ability to prepay the back, the debt and the likelihood to default, the access to the credit rating is comprehensive and identify the third party evaluation of the same. The takes account of the financial position and several qualities of the permanent of EMS. This have the bearing of the credit worthiness of the entity. Adequacy of the credit flow of the help to survive the overall growth of economy. The credit rating provide the objective of ascertain the regards their performance and capability of the financial strategies, which help to establish their credibility and access to adequate timely function being the affordable. The credit rating is generally exposed in India. Credit rate in 1987, CRISIL was promoted to uh, primary financial institution like ICICI, HDFC, UTI, SBI, LIC, and Asian Development Bank. Now the CRISIL is a S&P company, which majority of the shareholding apart from the CRISIL 4. So the more rating agents having been registered in SEBI in India. These are ICRA promotes by IFC, it means Indian Financial Companies, and now the controlled by the Moody's Care, promotion by the IDBI, Finch India, a 100% subsidy of the Finch, and now the borrowing of the brickwork. In India, the this rate capital market instruments are government by the Securities of Exchange Board, means SEBI, credit rating agencies regulatory in 1999. The regulatory provide the detailed requirement of the rating agencies need in fulfill of the register with SEBI. The credit rating is a technical and option on the relative degree of the risk associated with the timely payment of the interest and principal of the debt instrument. It is a information indicate to likelihood of the default of the insurer and the debt instrument relative to the respect of the like how to difficult of other issues in the market. This therefore is independent every to use measure of the related credit risk given the universal reliance on the rating of hence the power of option. Credit rating is expected to increase a efficiency of market and reducing information uh, at lower cost of the both borrowing and leaders. Credit risk is the risk related to non-repayment of the credit obtaining by the customer of bank. Thus, it is necessary to appreciate to the credibility of the customer in order to magnify the credit risk. The proper evaluation of the customer appraisal is the process ascertain to the risk associated with the extension of credit facility. It is generally carried by the financial institutions are include a providing financial to the customer. Credit appraisal means an investigation done by the bank prior before the providing a loan and um, advanced project of the finance and also check of commercial and financial technical ability to project promotes of the funding partner and future check of primary and securities covered availability of the recovery of such funds. So this is the summary which ended with the credit rating. First, in this all chapter is cover credit and the credit appraisal process of related with the company and the bank finance. Uh, After given keywords, various words like credit appraisal, credit rating, credit risk, default risk, and liquidity risk, hypothesis, and the pledge, the cash deposit or being a owner property of the debtor to credit security of the loan obligation. म्हणजे मराठीमध्ये आपण त्याला दिवाळ असं म्हणतो. दिवाळ निघाली म्हणजे एखाद्या एखादं लोन रिपेमेंट केल्यानंतर बँक ती प्रॉपर्टी ॲक्वायर करते आणि अजूनही रिपेमेंट होत नसेल तर ती लिलावी काढते. ते लिलावी म्हणजे so we all which related with credit rating and credit rating is basically for the institution or firm which have money or which uh, make to profit or expansion of companies whole in practical way with the help of these financial facilities. Next chapter is development bank. The concept of development bank rise only after Second World War, maintaining after credit disappeared in 1930. The demand of the reconstruction fund from the affecting the nation forced to set up a worldwide the institution of the reconstruction and a for the reconstruction of the development was set up as worldwide institution for the development of the reconstruction. Nation and nation and development object among the world. In 1947, the India had the development bank system, the adopting the bank domain of the nation development strategy, which aimed to meet a sector credit need to price particular of the agriculture industry. In 1947, India had a development bank system. Adopting the banking document, the development strategy, which aimed to meet the sectoral credit need, particularly in agriculture of the industry. RBI concerned to regulate developing the measure of the industrial building. So they can make various banks which are called development banks, IDBI, NABARD, NHB, SIDB, So these are the example of development bank. Concept of development banking, financial institution, the medium of long-term financial assignment, the engage of promotion and development of industry, agriculture and the other key sector. These are no in development financial institution. Development institutions are acquired financial institutions that act to dynamic agent in promoting the balanced developing of the country. The institution provide the fund to new and upcoming business and economic development project in the forms of equity share and loan capital. They provide the financial both private and public sector. They are also provide development of the promotional services that can aid in the growth of the economy. Its primary objective to economic development and promoting the investment and entrepreneurial activity to develop economy in encourage the new and small enterprise are balance recognition growth. Feature of development financial institution is development financial institution does not accept the deposit from the public. It is a specific financial institution to provide minimum, medium, and long-term facilities. Therefore, they are known in long-term and term leading institutions. It provides financial assistance to both private and public sector for undertaking. The object of these institutions to service public interest in rather they are the profit. The major role of the development financial institution is filling the financial gap in the existing financial facility. Therefore, it is does not compare to the this is normal challenges in finance. That is the financial already made available by the banks and other conventional financial institutions. Development facility institution normally have the high debt and equity ratio. The monitor of the activity, the borrowing firm, the special form of the banking known as a relationship banking. It is involved in nomination of the directors on the board of company who have to either review the financial and companies involved. It leading take to corrective action on time of case of any sign of error. The development financial institution are provide financial assistance in drawing up a project plan, identify the technology and implementation of the project. The development financial institution are the component of financial structure of that can be ensure the lead of the productive investment of the growth of making leading such systems. So these are the main criteria and main important points which related with developing banks, the financial institution of the small and the new business. The development financial institution in India have achieved remarkable success in credit a new class of entrepreneur and specific the industry culture never area to section to society. Special capital and seed capital. Seed capital means the capital which grow in future because the new leading companies they have one financial backup and they give some capital investment from bank. uh, the bank are see the main idea of related firms and they can give the loan to those companies. They make profits and this profit is added in capital activity which is seed capital. So please underline the seed capital, special capital and seed capital scheme. So new companies, they have they give bank give various facilities which related with the financial, which is no any other history to make any succeed or to repayment. So this called seed capital. Seed capital is already asked in examination in many times. Please underline this word seed capital. They also provide a package of service and information preparation of the facility of the report, project report, and technical managed consultant, etc. at a reasonable cost. These institutions have supported to chain in 16 technical consultant organization, converting the practically the entire country to develop financial institutions are also activated involved in promotion of development activities among their uh, premium facility of the finance. The promotion of the activity like carry the industrial potential survey, identify the potential entrepreneur, concluding the entrepreneur development programs and providing the technical consultancy services have contributed in a significant manner to process in identify an effective utilization of industrial finance by industry. Over the year, the scope of promotional activity has expanded to include program to upgradation of the skill and state level uh, development bank. Other industrial promote agencies, these institutions also conduct the special studies on improve the issue a industrial development, ensuring the voluntary agency implementing the program of their uninflammable of the moral area, the village bus based cottage industry ascertain the other weaker securities of the society. Operations in India have been primarily guided by the from properties of the spending out in a 5-year plan. This is the reflection in leading portfolio and the pattern of the financial assistance to develop the financial institution under different scheme of the finance. The institutional finance project in the area, the extent of the concessional terms such as lower interest rate, lower maintenance period, and extended repayment schedule. These relaxation norms are respected to promotes the contribution to debt equity ratio. Such consequences are extended to grade scale to unit in the industrial background. Distinct classification into three categories: A, B, and C, depending upon the degree of their backwardness. Beside the of expanding the term loan and the project area specific infrastructure development. Moreover, the recent year, the Development Bank of the India have on the specific promotion to identify the development of the industry leading developing area. Commonly, the reflection of the non-industrial district such do not have any large scale or medium scale industries. The project industry have initiated industrial promotional survey in this area. Therefore, the development of the institution are actively involved in the growth of the expansion of business. into new area as well as the new segments. So these are the points which are cover for the uh, role of developing financial institution of small and new business. So seed capital is very important point in that. So you can just underline those lines. In next lecture, we focusing on the various terms of developing bank and the phases and many more. So next lecture we can continue this topic. Uh, Till then we stop here today, and we surely make good in next lecture. Thank you.